Invest $200 a month starting at 25, and you retire a millionaire. That is the claim. It appears on brokerage banners and retirement seminars and the opening slide of nearly every financial literacy class in the country. $200. One coffee habit. $1 million waiting at the end. Now set two ages side by side, 25 and 35. Same $200 a month, same market, same everything. Except one saver begins a decade later. The standard telling gives the 25-year-old roughly $1.1 million by age 65. The 35-year-old, starting 10 years later, lands near $480,000. Same monthly deposit, same discipline, and yet the earlier start finishes with more than double the money. The extra decade cost that first saver $24,000 in additional contributions, 10 years of $200 payments. In return, the ending balance grew by more than $600,000. That is the number on the poster. That is the reason start early has become the closest thing personal finance has to gospel. And it is exactly the kind of number that should make a careful person suspicious. Because a figure that clean is never just arithmetic. It is arithmetic plus a stack of assumptions. And every assumption is a decision someone made on the viewer's behalf. Consider what has to be true for $200 a month to become $1.1 million. The money has to compound at a specific rate every year for 40 years. The contribution can never stop, never shrink, never pause for a job loss or a medical bill or a stretch of simply not feeling like it. The $1 million is counted in the dollars of the year 2065, not today. No taxes are subtracted along the way. No fees are quietly skimmed off the top. And the saver, crucially, never quits. Strip any one of those out and the poster number begins to move. Take the return rate alone. The 1.1 million figure typically assumes something close to a 10% annual return, a number pulled from the long-run average of the US stock market. That average is real. It comes from roughly a century of index data, but an average is not a promise, and a nominal average is not what ends up in a retiree's grocery budget. There is a gap between the 10% on the poster and the return a human being actually keeps, and that gap is where this entire investigation lives. So here is the question worth 40 years of anyone's attention. How much is one extra decade of investing really worth in today's dollars after everything is subtracted? Not the marketing figure. The one that survives inflation, taxes, fees, and the ordinary human tendency to stop. This channel is going to take that $1.1 million apart, assumption by assumption, and rebuild it into a number that would hold up in an audit. Some of what comes off will be larger, probably, than most people expect. The honest figure at the end will look nothing like the poster. But there is a twist that the skeptics tend to miss, and it is the reason this matters at all. Even after the deflated, taxed, fee-drained, quit-adjusted number is finished shrinking, it will still beat the late starter, the one who waited, then tried to make up for lost time with far bigger deposits. The advantage survives the audit. It just does not survive it for the reason everyone thinks. That $1 million figure rests on a single number nobody in the ad ever says out loud. That poster number, $1.1 million, is not a fact. It is a forecast wearing the costume of a fact. And like any forecast, it is only as sound as the inputs feeding it. Pull those inputs into the light, and the confident single figure turns out to be a tower of stacked guesses, each one balanced on the one beneath it. Here is how the tower is built. At the bottom sits a mechanism most people never inspect, because they only ever see the top. A future value calculation takes 3 ingredients and 1 operation. The ingredients are a monthly contribution, a rate of return, and a span of time. The operation is compounding return earned on prior returns, repeated for as many periods as the time span allows. Feed in $200, 10%, and 480 months, and the machine outputs $1.1 million. Change any single ingredient and the output does not nudge. It swings. That is the first thing worth understanding about this kind of number. It is not additive, it is multiplicative. In an additive process, a small error stays small. In a compounding one, a small error at the base is multiplied by itself 40 times over. The rate of return does not sit alongside the other assumptions. It sits underneath them, and everything else rests on its shoulders. Now watch what the tower quietly assumes above that base layer. It assumes the $200 arrives every month for 480 consecutive months without a single miss. It assumes the dollar in 2065 buys what the dollar buys today. It assumes the government takes nothing on the way, and the fund manager takes nothing off the top. It assumes the saver, at no point across 4 decades, looks at a falling account balance and decides to stop. 6 assumptions, stacked, each presented as if it were settled, and each one, on inspection, a choice someone made to keep the final figure round and impressive. The contrast is what should unsettle a careful viewer. On the poster, these 6 inputs are invisible. There is only the output, $1,100,000, printed in bold, offered as arithmetic. But arithmetic has no assumptions. Arithmetic says 2 plus 2. What the poster is actually doing is projection, and a projection is only ever a claim about how obedient the future intends to be. Consider the difference in stakes between the bottom of the tower and the top. The quit rate assumption, sitting near the top, changes the outcome for one saver at a time. If it fails, one person walks away with less. But the return assumption sits at the foundation, compounded 480 times. A gap of 2 percentage points there. The difference between the 10% on the banner and something closer to what a real portfolio yields after the market's rough decades are counted, does not shave the ending balance. It can cut it by a third or more, because those 2 points were never subtracted once. They were subtracted, silently, from every period, and then that subtraction was compounded along with everything else. This is the deepening the skeptic was right to sense. The $1 million number is not one claim. It is one claim wearing 5 other claims underneath it, and the whole outfit hangs from the single thread at the bottom, the assumed rate of return. Everyone quotes the top of the tower, almost no one names the base. The audit has to start where the weight is. Not with taxes, not with fees, not with the human habit of quitting. Those come later, and they take their own toll. It starts with the number the advertisement never says out loud, the one doing the heaviest lifting and getting none of the scrutiny. Pull that first assumption, the return rate, and watch the whole tower lean. 10% a year. That is the thread the whole tower hangs from, so it is the thread to pull first. And the obvious objection comes fast. Who promised anyone 10%? Markets crash. Lost decades happen. A saver who started in 2000 spent the next 13 years watching an S&P index fund go essentially nowhere before it recovered. 10% looks less like a return and more like a sales figure, a round, generous number chosen to make the poster work. The objection is fair. It deserves the strongest possible answer before it gets dismissed. So here is the steelman, the case for the defense, made as well as it can be made. The 10% figure is not invented. It is drawn from the long-run record of the U.S. stock market, and that record is remarkably stubborn. Measured across roughly a century, from the mid-1920s forward, the S&P 500 and its predecessors have returned close to 10% per year on average, with dividends reinvested. That is not one analyst's forecast. That is what actually happened through the Depression, the war economy, the inflation of the 1970s, the crashes of 1987, 2000, and 2008. The number survived all of it. Anyone who invested broadly and simply refused to sell captured something in that neighborhood over a long enough horizon. The defense rests on history, and the history is real. Consider how durable that pattern has been across regimes that had nothing else in common. The 1950s investor and the 2010s investor lived in different countries. Economically speaking, different tax codes, different industries, different technologies. Yet stretch the measuring tape across enough years, and the annualized figure keeps landing in the same zone. A rule of thumb becomes gospel precisely because it keeps being roughly right. The advertisers did not fabricate 10%, they borrowed it from the ledger. Which is exactly why the rebuttal has to be careful, because the number is not wrong, it is just measured in the wrong units. Here is the flaw. That century of 10% is a nominal figure. It counts dollars as if $1 in 1935 and $1 in 2023 were the same object. They are not. Over that same historical span, US inflation averaged roughly 3% a year. The purchasing power of the currency was quietly draining out of the bottom of the account the entire time the balance was climbing. So the investor earning the celebrated 10% was not getting 10% richer in any sense that buys groceries. Strip out inflation, and the long-run real return of US stocks lands closer to 7%. That is the number economists use when they are being honest, and it comes from the same historical index data the 10% came from. Same ledger. Different, truer column. Notice what just happened. The poster's most defensible assumption, the one backed by 100 years of evidence, is technically correct and still misleading. Both things are true at once. The market really did average 10%, and the saver really did not keep 10%, because 3 of those points were consumed by a shrinking dollar before they ever reached the future. This is the pattern the rest of the audit will follow. Each assumption on the poster is not a lie. It is a truth quoted in flattering units. The return is real but nominal. Later, the contribution will be real but uninterrupted. The balance will be real but pre-tax. Every layer tells a fact and hides a subtraction inside it. So the first assumption does not get pulled out entirely. It gets corrected. 10% becomes 7. And even that small-sounding move, 3 points off the base of a tower compounded 480 times, is enough to make the whole structure lean because the correction is not subtracted once. It is subtracted from every single period, then compounded along with everything else. The advertised rate, in other words, is technically defensible. It is simply measured in a currency that quietly shrinks. Before the corrected return gets applied, one question has been left hanging since the first frame, and it is worth settling now. Who decided that $200 a month becomes a millionaire? And why did that particular sentence spread to every seminar in the country? Trace it backward, and the trail does not lead to a brokerage marketing department, though that is where it ended up. It leads to a genuine shift in how ordinary Americans were expected to fund old age. Start in 1978. A single clause added to the tax code that year, Section 401(k), was meant to govern deferred compensation for a narrow slice of executives. It was not designed to move the retirement of a nation. But by the early 1980s, benefits consultants had noticed the clause could be read far more broadly, and employers seized it. Between 1980 and the mid-1990s, the defined benefit pension, the plan where the company carried the investment risk and simply promised a check, went into steep decline, and the defined contribution account, where the worker carried the risk alone, took its place. The burden of the math moved from the employer's actuaries to the individual's kitchen table. That transfer is the turning point, and it created a problem nobody had needed to solve before. Tens of millions of people who had never chosen an investment in their lives were suddenly responsible for choosing all of them. They needed a rule simple enough to fit on a page and reassuring enough to act on. The financial industry, now selling mutual funds directly to these newly responsible savers, supplied one. The rule took its cleanest form in a place worth naming. In 1994, a Stanford-trained advisor named William Bengen published research establishing the 4% rule for safe withdrawals. And while that specific work addressed spending in retirement, it belonged to a wave of tidy, mass-market retirement heuristics arriving in the same decade. The Start Early and Retire a Millionaire chart rode that same wave. Its power was never precision. Its power was that it fit on a brochure, survived being repeated by someone who did not understand it, and pointed a frightened first-time investor toward action instead of paralysis. Consider what that rule was actually engineered to do. It was not built to forecast a real person's balance. It was built to overcome inertia, to get a 25-year-old who had just been handed a 401(k) enrollment form to check the box and contribute something rather than nothing. For that job, a round, optimistic 10%-fueled million-dollar promise worked better than an honest, hedged, inflation-adjusted estimate ever could. The number was a recruiting poster, and recruiting posters are not audited financial statements. Which is the consequence that closes this part of the story. The start at 25 and you'll have a million figure came from the collision of 3 forces in a single decade. A tax accident that shifted retirement risk onto individuals, an industry that needed those individuals to buy funds, and a real market average, that stubborn nominal 10%, that made the optimistic version look responsible rather than reckless. It was never a lie invented from nothing. It was a true long-run return, dressed in round numbers, aimed at people who badly needed a reason to start. The poster worked because it was mostly true and entirely flattering. That combination is exactly what makes it dangerous to plan a life around. The number is not the output of a neutral calculator. It is a behavioral tool, born of a 1978 tax clause and a 1990 sales problem, carrying a real market figure inside a marketing frame. And a marketing figure has a job the moment the light hits it, to hold up or to move. The origin is settled. The return has already been corrected from 10% to 7%. Now the audit can proceed in order, and the first correction to apply against the balance itself is the one the poster hides in plain sight. The quiet 3% drain that was draining the account the whole time. A number can be entirely accurate and still describe a life the saver will never live. That is the strange property of the poster's $1 million. It is not inflated in the ordinary sense. Nobody padded the arithmetic. The 1.1 million is what $200 a month at 7% real would actually total on the machine. And yet the figure is quietly lying, because it is denominated in a currency that does not stand still. Here is the mechanism, stated plainly. A dollar promised for the year 2065 is not a 2025 dollar wearing a later date. It is a smaller thing. Inflation is not a tax the saver pays. It is a slow erosion of what each dollar can buy, running underneath the account balance the entire 40 years, invisible, because the balance itself keeps climbing. The number on the statement goes up. The number that matters, what those dollars will command in groceries, rent, and medicine at 65, goes up far less. The poster reports the first number and lets the viewer assume it means the second. So the correction is not another subtraction from the return, it has already been made. When the audit dropped the rate from 10% to 7% in the previous step, it was doing exactly this work. Pulling the roughly 3 points of average annual inflation out of the nominal figure. The question that remains is what that correction does to the ending balance once it compounds across 480 months. Consider the two towers side by side. Run $200 a month at the nominal 10% for 40 years, and the machine returns the familiar 1.1 million. Now run the same $200 at the real 7% for the same 40 years. The output is not 1.1 million minus a little. It is roughly $525,000 in today's purchasing power. Read that twice. The same contribution, the same discipline, the same market, measured in dollars that actually buy something, produces less than half the headline. The poster's million was never a million. It was a million future dollars, and future dollars are a depreciating currency the ad forgot to mention. Why the cut is so brutal is worth sitting with, because 3 percentage points sounds trivial against 10. It is trivial, for 1 year. But this is the multiplicative machine from earlier, doing its work in the other direction. Those 3 points were not deducted once at the end. They were removed from every single period and then denied the chance to compound. 40 years of compounding that never happened is what the gap represents. The magic that built the poster number, return earned on prior returns, runs in reverse when the return itself is smaller. The saver does not lose a third of the balance. The saver loses a third of the compounding, which is a far larger thing wearing a modest-looking label. Now the application, which is the only part that touches a real life. A 25-year-old reading the brochure hears, "You will be a millionaire," and pictures what $1 million buys today: a paid house, a comfortable decade, room to breathe. That picture is the actual promise being made, whether the fine print admits it or not. The honest translation is different. Contribute $200 a month, faithfully, for 4 decades, and you can expect roughly the purchasing power of $500,000 of today's dollars. Still a serious sum. Still more than most Americans reach, but half the dream on the wall. This is the first honest figure the audit produces, and it is worth naming as a marker, about 525,000 real dollars, down from the advertised 1.1 million. One assumption corrected, the currency and the poster has surrendered roughly a third of its face value. And that is the gentlest cut coming. Inflation is impersonal. It treats every investor the same and takes no one's side. The next subtractions are not impersonal at all. They are levied by specific parties with claims on the account, and they have not yet taken a cent. The million just lost a third of its face value, and the taxman has not even arrived. Who exactly has a legal claim on the $525,000 the audit just arrived at, and how much do they take before the saver spends a single dollar of it? That question has a precise answer, and it depends almost entirely on one choice made on the day the account was opened. Walk into the moment of that choice. A 25-year-old sits with an enrollment form and two boxes. One says traditional, one says Roth. To most first-time savers, the distinction reads as paperwork, a formatting preference, not a fork in the road. It is, in fact, the single decision on the page that determines who owns a slice of the ending balance, the saver or the treasury. The form does not say this. The brochure does not say this. The poster's $1 million was printed as if no one else had a claim at all. Here is what the two boxes actually mean. In a traditional account, contributions go in untaxed, grow untaxed, and are taxed as ordinary income on the way out, decade by decade, as the money is withdrawn in retirement. In a Roth, contributions are taxed the year they are made, and everything after that, 4 decades of growth, every dollar of compounding, comes out entirely tax-free. Same market, same $200, two completely different owners waiting at the finish line. Set the scenarios beside each other and the slice becomes visible. Take the traditional saver first. That $525,000 in real purchasing power is a pre-tax figure. The government has not yet been paid. Assume this retiree draws the money down in lands, blended across brackets, at an effective rate of roughly 15% on withdrawals. 15% of $525,000 is about $79,000, claimed by a party who contributed nothing to the account and carried none of the risk. What the saver keeps is closer to $446,000 in today's dollars. Now the Roth saver. The tax was paid up front out of the same $200 monthly capacity, which means slightly less was invested along the way, a real cost the comparison must honor. But the ending balance is clean. No withdrawal tax, no bracket math, no treasury slice at 65. The $446,000 versus $525,000 gap the traditional saver suffers at the end does not exist here. It was paid in smaller pieces decades earlier when the dollars were fewer and the rate was likely lower. The lesson is not that one box beats the other. It is that the poster's million never specified which one it was describing, and the two answers differ by tens of thousands of real dollars. A figure quoted without an account type is a figure quoted without an owner. The honest number this audit is tracking has to pick a side, so it holds the more conservative case, the traditional saver keeping roughly $446,000 in today's purchasing power after the taxman is paid. Sit with the arithmetic of that descent. The poster said 1.1 million. Inflation took it to 525,000. Taxes, on the traditional path, take it to about 446,000. Two assumptions corrected, and the face value on the brochure has surrendered nearly 60% of what it promised. Nothing dishonest happened at any step. Each subtraction was a true claim the ad simply declined to mention. And notice which claims those were. Inflation is a force. Taxes are a party. The Treasury, with a statute behind it. Both are at least visible. A saver can read about brackets and inflation rates. The next subtraction is different in kind. It is not a force of nature and not an arm of the government. It is a private party, paid automatically, itemized on no statement the saver ever reads closely, taking its cut every year whether the market rises or falls. One more subtraction remains, and it is the one most savers never see on any statement. A leak in a boat does not announce itself. The water does not send a bill, does not ring a bell, does not appear as a line the sailor has to approve. It simply enters a little each hour below the waterline in a place no one thinks to look, and the boat rides slightly lower every year until the day someone finally measures the draft and cannot understand where the buoyancy went. The fund fee is that leak. It is the one subtraction in this entire audit that the saver signs up for, pays continuously, and almost never sees. Here is the mechanism, because the mechanism is the whole trick. A fund's expense ratio is not charged as a visible withdrawal. There is no annual invoice for management, $421. Instead, the fee is skimmed off the fund's return before that return is ever reported. If the market delivers 7% and the fund charges 1%, the statement shows 6%, and the saver reads 6% as simply what the market did. The subtraction has been folded into the number before the number reaches human eyes. That is why fees feel painless. They are engineered to be invisible, not hidden illegally, just netted out one layer upstream of attention. And a fee taken off the return is not a fee taken off the balance. This is the distinction that undoes people. A 1% charge on a $446,000 account sounds like $460, annoying, survivable. But that is not how it works over 40 years. The fee is levied every period, on the whole balance, and the dollars it removes are dollars that can never compound again. The saver does not lose 1%. The saver loses 1%, plus all the growth that 1% would have produced, plus the growth on that growth 480 times. Run it through the machine. Take the real return the audit already established, 7%, and split it two ways. In the first case, a low-cost index fund charges roughly 0.05%, near the floor of what is available today. In the second, an actively managed fund charges 1%, which is unremarkable and still common. Over 40 years of $200 monthly contributions, that gap of 0.95 of a percentage point does not cost a few $1,000s. Measured in today's purchasing power, it quietly removes somewhere on the order of $90,000 to $100,000 from the ending balance, roughly a fifth of everything that survived inflation and taxes. Read that against the size of the number doing the damage, 1%, a rounding error in conversation, a figure so small the brain files it under negligible. And it consumes a fifth of a life's accumulation, not because the percentage is large, but because it is charged relentlessly against a compounding base. The industry that inherited the retirement of a nation in the 1980s did not need to overcharge. It only needed to charge quietly, forever, on a number that grew every year it was charging. There is something almost elegant in the cold sense about how this cut differs from the others. Inflation is impersonal, a force that takes no side. Taxes are a party with a statute, at least written down where a diligent person can find them. But the fee is the only subtraction the saver actively chose, on the day the account was opened, usually without reading the one line that decided it. It is the leak below the waterline that the sailor bored himself, with a drill he was told was standard equipment. So the honest number takes its final scheduled cut. The poster promised $1.1 million. Inflation brought it to $525,000. Taxes on the conservative path to about $446,000. Now fees, in the ordinary 1% case, carry it down toward the neighborhood of $350,000 real dollars. Add every cut together, and the honest number finally stands in the open, smaller and stranger than the poster ever let on, $350,000. That is where the audit leaves the poster's million after inflation, taxes, and fees have each taken a defensible cut. But one subtraction is still missing, and it is the largest of them all. Larger than the tax slice, larger than the fee leak, because it does not shave the balance. It erases it. The assumption every version of the poster makes, silently, is that the saver never stops. 40 years. 480 consecutive deposits. No paused contribution during a layoff, no drained account after a medical bill, no panic sell in March of 2009 when the balance had fallen by half and every instinct screamed to get out. The 350,000 figure assumes a human being who behaves, for 4 decades, like a standing bank order. That person is rare. Here is the tension the whole audit has been building toward. Every cut so far has been a haircut, a percentage off a surviving balance. The quid is not a haircut. It is a cliff. A saver who stops contributing at year 12 and never restarts does not end with 60% of the honest number. They end with whatever the first 12 years accumulated, frozen, and then quietly eroded by the same fees for the remaining 28. The behavioral variable does not scale the outcome down, it removes the outcome entirely. And the data on quitting is not gentle. Studies of 401k participation consistently find that a large share of accounts see contributions stop, drop, or get cashed out at job changes, with leakage through early withdrawals and loans draining a meaningful fraction of balances before retirement. The saver who reaches 65 having never once interrupted the deposit is not the average case. They are the exception the poster quietly assumed was the rule. So how is this priced into a single honest figure? Not as another percentage off 350,000, it is priced as probability. Weight the ending balance by the realistic odds of completing the full 40 years without a disqualifying interruption, and the expected value, the number a statistician would actually bet on for a random 25-year-old who checks the box today, falls well below the 350,000 the disciplined path produces. Somewhere in the neighborhood of 250,000 real dollars, once the odds of quitting are honestly folded in. That is the relief, such as it is. Not a comforting number. A defensible one. A figure that would survive an audit, because every assumption underneath it has been tested and corrected rather than borrowed from a brochure. The poster said 1.1 million. The honest expected value in today's purchasing power, after inflation, after taxes, after fees, after the ordinary human odds of not finishing, is closer to a quarter of that. Sit with the full descent, because this is the answer to the question that opened the entire investigation. What is left of the promise after reality takes its cut? Nominal 10% became real 7, and 1.1 million became 525,000. Taxes on the conservative path carried it to 446,000. 1% in fees drained it toward 350,000. The plain odds of a human being not completing 4 uninterrupted decades pulled the expected value down near 250,000. The poster surrendered roughly 3/4 of its face value on the way to a number that can actually be defended. And here is the revelation the audit was built to deliver. The 1.1 million was never the real product. It was the recruiting figure. The round, flattering, inflation-blind number designed in a 1990s sales problem to get a frightened first-time investor to check a box. The $250,000 is what the early start is actually worth to a real person living a real, interrupted life. It is smaller than the dream on the wall by a wide margin. It should be disappointing. By every measure the poster taught the viewer to use, it is a letdown. Which sets up the only question that still matters. If the honest early start figure has collapsed this far, from $1 million promise to a $250,000 expected value, then surely a determined late starter, contributing far more money for the years they have left, can close that gap and pass it. The shrunken number is a disappointment, so why does it still crush every late start anyone can construct? Give the late starter every advantage the early saver never had: more income, more discipline, more money on the table, far more. Then watch the math refuse to cooperate. Set the two scenarios side by side, using the same corrected inputs the audit has been building on: 7% real, 1% in fees, the conservative tax path. The early saver is the one already measured $200 a month from age 25, 40 years, an expected value near 250,000 real dollars once the odds of quitting are folded in. Now build the late starter to win. This person waits until 35, spends their 20s on other things, and then, alarmed and determined, commits not $200 a month, but $400. Double the deposit, 30 years to run instead of 40. Do the accounting the poster never does. The early saver, over their career, will have contributed $96,000 of their own money, $200 a month for 480 months. The late saver, at $400 a month for 360 months, contributes $144,000. That is 50% more cash out of pocket than the early starter ever put in. By the logic of effort, the late saver should finish ahead. They tried harder, they gave up more. Run both through the same machine, in the same real dollars, and the late saver arrives near 245,000, and that figure has not yet been discounted for their own odds of quitting, which are no better than anyone's. The early saver, having contributed a third less money, sits at roughly the same place or ahead. 50,000 extra dollars of contributions, and the late start cannot buy back the decade it skipped. Here is the central truth the comparison exposes. The early saver's advantage was never the money. It was time occupying the position where compounding does its heaviest lifting. The first decade of any account contributes almost nothing to the ending balance in raw deposits, a few $1,000s a year, but those early dollars compound the longest, and in a multiplicative process, the longest compounding dollars are worth many times the latecomers. The late savers' $400 a month contributions are heavy, but they arrive too late to grow. They are cash dropped near the finish line, where there is no time left to multiply. Unfold that, and the injustice sharpens. To actually pass the early saver, the late starter does not need to double the contribution. Run the numbers, and they need to roughly triple it, somewhere near $600 a month, sustained flawlessly for 30 years, to reach parity with a person who quietly set aside $200 and largely forgot about it. Triple the monthly burden on an income that must also carry a mortgage, children, and the accumulated obligations of a life already underway at 35. The catch-up is not impossible on a spreadsheet, it is close to impossible in a budget. This is where the honest figure earns its keep. The skeptic's fear at the start of this investigation was that "start early" was oversold, a slogan hiding a modest reality. Half of that fear was correct. The $1 million was a fiction. The real number is a quarter of it. But the other half was wrong. Even that, deflated, taxed, fee-drained, quit-adjusted $250,000, cannot be caught by a later start throwing 50% more money at the problem. The advantage shrank enormously in absolute size and did not shrink at all in relative terms. Against every late start a determined person can realistically construct, the early start wins. So the poster lied about the size of the prize and told the truth about the direction. The audit has now confirmed both. The honest expected value is far smaller than advertised, and still decisively larger than any catch-up the arithmetic allows. But notice what the comparison quietly revealed and then set aside. The early saver won partly because they largely forgot about it, because the deposit became automatic, invisible, a habit that ran for 40 years without a decision. That phrase was doing more work than it looked. The math says early wins, but the math is not the real reason it wins. Nobody sets up a $200 automatic transfer and then thinks about it every month for 40 years. That is the quiet fact the whole comparison rested on and never examined. The early saver won in the last accounting, partly because the deposit disappeared into the background, scheduled, silent, running on a day of the month they could not name if asked. And that ordinary detail turns out to be the actual engine, not the interest. Watch what genuinely happens in the first decade of an account. In raw dollars, those early contributions are almost nothing, a few thousand a year, a balance that grows slowly and unimpressively. A 27-year-old checking the statement sees a number that feels too small to matter. By the poster's own logic, the early years are the least productive. Little money, modest growth, nothing to celebrate. If the payoff were the point, quitting in year 3 would look entirely rational. But something else is being built in those years, and it does not appear on any statement. What the first decade manufactures is not a balance, it is a default. The saver who contributes automatically from 25 to 35 is not accumulating much wealth. The audit already showed the early dollars are small. They are accumulating something harder to price. A settled behavior, a transfer that no longer requires a decision, a self-image of a person who invests. By 35, contributing is no longer a choice they make each month. It is a fact about their life, like a mortgage payment or a commute. The decision was made once, years earlier, and then never revisited. This is where the quit rate variable from earlier turns inside out. The honest number fell to $250,000, largely because so many savers stop, leakage, cash outs, paused contributions at every job change. But the study data points to something the raw quit rate obscures. The accounts most likely to survive a full career are the ones that were automated early and never became a live decision again. Research on automatic enrollment found that when contributing is the default rather than an active choice, participation jumps dramatically and stays high, behavior that persists for years after the nudge because the saver stops redeciding. Expand that mechanism, and the whole investigation reorganizes around it. The late starter does not just lose a decade of compounding. They lose the decade in which the habit sets, and they arrive at 35, having to build two things at once, the balance and the behavior, under a budget already loaded with a mortgage and children. That is why their tripled contribution collapses so often in practice. It is not that the arithmetic defeats them. It is that a $600 deposit that requires monthly willpower is a deposit that eventually meets a month where willpower loses. The early savers' real advantage was structural. They spent their least productive dollars buying the one thing that cannot be caught up on. A decade in which investing stopped being a decision. The interest was the smaller prize. The automaticity was the larger one, purchased cheaply, with contributions so small they barely registered. Which reframes the entire cost of starting. The fear that keeps a 30-year-old from opening an account is the fear of the amount that $200 a month is a serious commitment, that the number needs to be big to matter, that starting small is barely worth the trouble. The audit says the opposite. The early dollars were never supposed to be large. Their job was never to accumulate. Their job was to establish the default before life got expensive, and a default costs almost nothing to install. So the entry price is not the $1 million dream or even the $250,000 reality. The entry price is whatever the smallest automatic transfer is that a person will not turn off. Everything the poster promised, and everything the audit corrected, hangs on that one modest, boring act. If the first decade mostly buys the habit rather than the interest, then the cost of starting is far lower than anyone standing at the edge of it fears. $200 a month sounds like a plan. It is not. A plan is a thing you decide once and execute. $200 a month, framed as a monthly commitment, is a decision reopened 480 times, and the audit has already shown what happens to decisions reopened that often. They lose. So the concrete move is not invest $200 a month. The concrete move is narrower, colder, and far easier than that. Here is the action, stated as plainly as it can be. This month, open one account and set one automatic transfer on a fixed day into one low-cost broad market index fund and then make it invisible. Take those pieces one at a time because each maps directly onto a subtraction the audit already tested. Choose the account type first, because that single box decides who owns the ending balance. For most savers early in a career, with a tax rate likely lower now than in retirement, a Roth account settles the tax question cleanly. Contributions taxed once, upfront, and every dollar of 40 years, growth withdrawn free. That is the same choice worth roughly 79,000 real dollars in the earlier scenario. It is decided by checking a box, not by any market call. Choose the fund second, and choose for the fee. The audit showed 1% quietly removing a fifth of a lifetime's accumulation. A broad index fund charging near 0.05% removes almost nothing. This is the rare decision where the cheapest option and the best option are the same option, and it is made once. Then set the transfer and set it low. Lower than feels serious. Low enough that no future month produces the thought, I can't afford it this time. Because that thought is the cliff the entire quit rate collapse falls off of. The audit was unambiguous. The early dollars were never meant to accumulate. Their job is to install the default before life gets expensive. $50 that never stops beats $200 that gets switched off in a hard year and never switched back on. And that is the whole move, not a budget overhaul. Not a spreadsheet. One account, one fund, one automatic transfer, one afternoon. Consider what that afternoon actually purchases, measured against everything this investigation subtracted. It does not buy the poster's 1.1 million. That number was a recruiting figure denominated in shrinking dollars. It does not even reliably buy the honest $250,000, because a single act cannot guarantee 40 uninterrupted years. What it buys is the one input the late starter can never acquire at any price, a decade in which contributing stops being a choice. The transfer set this month is the transfer running, unexamined, on a random Tuesday in 2031, still building the habit while the balance is still too small to admire. There is a quiet dignity in doing something this modest against a promise this inflated. The industry sold $1 million dream, the audit returned a $250,000 reality. And the correct response to both the flattering fiction and the deflated truth is the same small, boring transfer, because it is the only part of the entire calculation a person actually controls. The return is the markets. Inflation is the currencies. Taxes are the statutes. The fee, once, is a choice. and then it is done. What remains in the saver's hands is a single lever. Whether the money leaves the checking account automatically, on a fixed day, without a decision. Pull that lever this month and the rest of the machine, the compounding, the decades, the habit runs on its own. Which brings the investigation back to where it began, to a question raised in the very first frame and deferred through every subtraction since. How much is one extra decade of investing really worth in today's dollars after everything is taken out? The number is finally standing in the open, and it can now be stated in dollars. A person can act on this afternoon. A saver opens a Roth account on a Sunday afternoon, sets a $50 transfer for the first of every month, chooses one broad index fund, and closes the laptop. Nothing feels different. The balance a month later is $50. By the standards of the poster that started all of this, it is a rounding error, too small to admire, too slow to celebrate. The saver forgets the day of the month it runs on within a year. That afternoon is the entire answer to the question this investigation opened with, stated in the exact terms the poster used and then abandoned. The advertisement promised $1.1 million. The audit took it apart in order. Nominal 10% was real 7, and the million became $525,000 in today's purchasing power. The Treasury's conservative slice carried it to about $446,000. 1% in ordinary fees drained it toward $350,000. And the plain human odds of not completing 40 uninterrupted years pulled the expected value down near $250,000 real dollars. 3/4 of the promise gone, not to any lie, but to 4 true subtractions the brochure declined to name. So here is the honest valuation of one extra decade, stated flat. In today's dollars, after inflation, after taxes, after fees, after the realistic chance of quitting, the early start is worth roughly $250,000 of expected value, and it defeats a late starter who contributes 50% more money and would need to nearly triple the deposit to catch up. That is the number that survives an audit, a quarter of what the poster shouted, and decisively larger than anything a later start can construct. There should be disappointment in that figure, and there is. A $1 million dream returned as a $250,000 reality is a letdown by every measure the advertisement taught. But the disappointment is measuring the wrong thing. The early dollars were never the prize. They were too small to be the prize. A few thousand a year growing slowly, unimpressive on every statement. What that first decade purchased was not a balance, it was a default. A transfer that stopped being a decision. A person who, by 35, invested the way they commuted without deciding to. The late starter cannot buy that at any monthly amount because they must build the balance and the behavior at once, on a budget already carrying a mortgage and children. The interest was the smaller advantage. The automaticity, installed cheaply before life got expensive, was the one that could not be caught. Which is why the true worth of the decade is not really $250,000. That is only what the machine outputs. The worth of the decade is that it converts a lifelong series of hard monthly decisions into a single easy one, made once on a Sunday afternoon and never reopened. Everything else in the calculation belongs to someone else. The return is the markets, the erosion is the currencies, the tax is the statutes. The fee chosen once is finished. The only lever left in a person's own hand is whether the money leaves the account automatically, on a fixed day, without a vote. That lever costs almost nothing to pull. It is also the only variable in this entire audit that decides everything. The poster was wrong about the size of the number and right about the direction. Start earlier and you end ahead, not by the million it promised, but by an amount no later effort can overtake. The correct response to the inflated dream and the deflated truth turns out to be identical. The same small, boring automatic transfer set this month, kept low enough that no hard year ever switches it off. That is what one extra decade is worth, not a fortune, a head start that compounds in dollars and, more quietly, in habit, and cannot be bought back once it is gone. This is education, not personalized advice. But the arithmetic has been laid open end to end, and it points to one modest act that a person standing at the edge of it can take before the month is over. Wealth is built to last. It is also built, it turns out, on a decision made once and never made again.